G'day everybody and welcome to Stuffed Up Crypto. My name's Steve and this is a place where we talk about all things crypto. Today I thought we'd have a look at different patterns in the charts. Chart patterns come in many shapes and sizes, so let's have a look at a few of the different ones now. The first one we'll look at is the head and shoulders pattern. It's called head and shoulders pattern because it resembles a person. We have the head in the middle, left shoulder and the right shoulder. We can also have an upside down head and shoulders. This is called an inverse head and shoulders pattern. As you can see, we have the upside down head, the left shoulder and the right shoulder. Head and shoulders patterns are reversal patterns. So when we have an upward trend and then we move into a head and shoulders pattern, when the head and shoulders pattern is completed, we are more likely to move to the downside. Conversely, when we have a downward trend and then we have an inverse head and shoulders pattern appear, when it is completed, we're more likely to move to the upside. Triangle patterns. They come in three types. We have the symmetrical triangle, an ascending triangle, and a descending triangle. Triangles are formed between converging lines of support and resistance. In an ascending triangle, we're more likely to continue the trend and break to the upside. In a descending triangle, we're more likely to continue the trend and break to the downside. A symmetrical triangle is more likely to break to the same way as the incoming trend. In this particular one, downward trend, breaking to the downside. Conversely, if it was an upward trend, breaking to the upside. Channels. This is where price moves between two parallel lines. We have our support and resistance. So an upward channel is where price moves between the support and resistance moving upwards. In a downward channel, price moves between support and resistance in a downward channel. Wedges. With wedges, we have two types, a rising wedge and a falling wedge. The rising wedge will tend to break to the downside. A falling wedge will tend to break to the upside. Wedges form between support and resistance lines that run together in either an upward or downward direction. The lines are tapering, and as we get further into the wedge pattern, we get less support for the movement on a rising wedge to the upside, and we break to the downside, and then the opposite in a falling wedge. Here we have a few more trading patterns, falling wedge and the rising wedge, as we explained before. Bullish rectangle. In an upward trend, the bullish rectangle is more likely to break to the upside. In a downward trend, the bearish rectangle is more likely to break to the downside. A bearish pennant, downward trend, more likely to break to the downside. A bullish pennant in an uptrend, more likely to break to the upside. Here we have different chart patterns in a larger chart. So moving from left to right, a double bottom would be a bullish indicator looking for movement to the upside. A bull flag with entry from the bottom looking for a movement to the upside. A bull pennant, once again the same thing. Now a rising wedge, as we described before, looking for a reversal to the downside. Falling wedge, looking for a reversal to the upside. Triple top, looking to break out to the bottom. Bear flag, looking to break out to the bottom. Bear pennant, same again. Inverted head and shoulders, the sign of a change in direction. We have movement in, shoulder, head, shoulder, coming from the downside, and then we reverse and move back to the upside. Inverted cup and handle, okay, an infrequently used pattern, so we'll leave it at that. Expanding wedge, coming in from the downside, looking to move to the upside. cup and handle pattern. Cup and handle pattern, we have the larger cup, the smaller handle, and this pattern tends to break to the upside. Head and shoulders pattern, shoulder, head, right shoulder, looking to break to the downside. Now, all these different charts and patterns that we've looked at today, the indicators only give an idea of which way the trend will go. Every indicator, if it looks like it can break to the down, it can break to the up. And every indicator, if it looks like it can break to the up, can break to the down. So it's a matter of probabilities. When we look at chart patterns, we use them to help us as a guide when using our other indicators as well. They're one tool in the toolkit, and combining the chart patterns with the candlestick patterns with all the other tools in our toolbox, then we can come to a conclusion and make a decision on which way we're going to trade the market.